Good morning and welcome to this webinar presented by myself. With me, George Glynos from ETM Analytics. George, interest currently, like we just chatted before and quickly, is there's a lot has an impact at the moment. You're going to touch on a few points, but there's geopolitical. The debate about interest rates in the US, the data in the US has been what's happening in the Eurozone, what's happening in this local market of ours. So for everybody out there, welcome. If you've got any questions, there's a chat. We'll try and tackle them as we go along. And then I'm going to hand over. Kick us off with what's happening in the markets.
Perfect. Thank you, Wichard, and good morning, everybody. Great to be with you again. As Wichard was alluding to, there's so much going on at the moment. It's difficult to know where to start and where to end. But I thought it's only appropriate, given that Trump wants the limelight so badly, that we start with him, because quite clearly he thrives off it, and he wants to be the center of attention. So let's give him a little bit of attention up front, because I think what's going on in America has profound consequences for the rest of the global economy, and naturally that's going to filter through into South Africa in a range of different ways. Probably the most important place to start is of course the tariffs, and we've been on a 90-day reprieve. And that's coming to an end beginning of next week. So early next week, we get to the end of these tariffs. On the 8th of July, they end. 9th of July, we get, the reprieve ends on the 8th of July. 9th of July, the tariffs are reinstated. And so South Africa is going to be sitting with 30% tariffs on any goods destined for the US. It's unclear exactly what the impact is going to be. It might not be entirely evident right up front, because some of these exporters have preemptively exported. We can see some of that in the trade numbers. We can see it in the US numbers as well. So there's a preemptive move that's taken place, and quite clearly some of these exporters have envisioned a disruption. And so they have tried to plan for it, and also bought themselves a little bit of time in case Trump decides that he's going to reinstate another reprieve for who knows how long. So it is very much a case of on again, off again, on again. We know that against China, he has imposed some heavy tariffs. Against the rest of the world, he's still in negotiations. I'm not clear where it is that South Africa finds itself with these negotiations. They're supposed to be in negotiations, but I haven't seen anything constructive as yet. And so naturally, we are anticipating that the tariffs will be imposed, and then we will see what the ultimate impact of that is. It makes any discussions on AGOA null and void, because these tariffs supersede everything else, and basically places us on a similar playing field to many other countries around the world. So we got to wait and see what happens next week. We know that Trump has got a tendency of changing his mind from one day to the next. So who knows? Next week we may be staring at a very different situation. Suffice to say that the tariffs will have an impact, and at least from the American perspective is likely to have somewhat of an inflationary impact. From a South African export perspective, it may detract, obviously, from South Africa's exports to the US.
George, just before you...
Yes, Wichard.
Obviously, what I've read is South Africa is actually looking for an extension.
Yeah.
We've got our first question already. I'm going to pop it up for you. It says, 4 preconditions on it. Will the ANC start economic growth on the tariffs, or what's your feeling on that?
Yeah, well, I mean, one of the things that they want is the ANC to go back on things like expropriation without compensation, and they want to or they've made a point of it, and the ANC needs to accept some of these things. Well, I don't see the ANC doing that. We had Melanie Verwoerd. We were chatting to Melanie Verwoerd, the political analyst, quite recently, and she said there's certain aspects of South Africa's policy, things like BEE and those race-based policies are not going to be changing anytime soon. It's a hallmark of their political stance, and so they're not going to go back on it. So if that is something that the US wishes to negotiate on, well, I don't know that there's a whole lot of room to maneuver. And so if you're asking me whether the ANC is suddenly going to shift policies like expropriation without compensation and BEE and the likes, the answer is no. I don't think they will. So the net result of that is that we are going to have to negotiate on other terms and see if those other terms are indeed, if those other terms are acceptable at all. And what might that be? Well, we know that we are the world's biggest platinum producer. That platinum production is strategic and core. It is important to many countries around the world. It's not obvious that we are still shifting wholeheartedly towards electric vehicles. There's obviously a big push, but there's still a sizable market that utilizes catalytic converters. So there's that. There's some rare earths that South Africa can also provide. So there's strategic value that South Africa can bring to the trade negotiations. But we're going to have to wait and see what that looks like. From a political point of view, though, I don't see the ANC shifting significantly on that front. Moving back to the presentation and the message that is coming out of the Trump administration is that quite clearly they've identified some imbalances that have arisen through the course of decades. And they are wanting to be the administration that tries to reverse some of these imbalances. The most obvious one, of course, is the trade balance, and you can see how the trade balance on the left-hand side has deteriorated very, very sharply. It's rebounded now more recently once the tariff reprieve was implemented. But what's very evident from the chart on the left is that the more the US Federal Reserve has loosened monetary policy, the more it has encouraged debt. In other words, the more that the US borrows from the future to consume now, the worse the trade deficit has become. So this isn't just a case of production shifting abroad. That's part of the issue. The other part of the issue is that the US has been running with unsustainable monetary policy. Of course, that unsustainable monetary policy is basically interest rates that are too low. And with interest rates that are that low, what it also does is it encourages debt accumulation, and debt accumulation not just in the private sector, but also in the public sector. And the chart on the right makes it very clear that the net interest costs on the debt that is likely to be accumulated by the US going forward is rising and rising very, very steeply. Now, we just heard this week that Trump's big, beautiful bill got passed through Congress, both the House and the Senate. He's going to be signing it into law today. The expectations from the Congressional Budget Office are that it will raise the debt pile by approximately $3 trillion over the next 10 years. Of course, those projections are based on a number of assumptions. One of the assumptions is that this big, beautiful bill is not going to boost growth at a more rapid rate than the rise in debt, in which case, on a debt to GDP ratio, it deteriorates. The Trump administration's view is that their growth efforts are going to yield some benefit to the US economy, and that they will get GDP growth rising at a rate faster than the rise in debt. To that, they want to collect more revenue from tariffs, of course, and then last but not least, they are wanting to enforce other tax collection methods, whilst at the same time cutting government expenditure. So the combination of all of that is how Trump envisages paying for this big, beautiful bill. But for now, the market is a little bit concerned that it's going to be it's going to result in more debt creation than anything else, and that has some people a little bit concerned. So naturally, when you have a look at US interest rates, they're remaining elevated. That's the bond market. It's the market interest rates are remaining elevated despite the Federal Reserve having cut interest rates a few times already. That's evident on the chart on the left. The chart on the right gives you a sense as to why. So if you have a look at the blue and the black bars, the blue bar is how much debt needs to be rolled over in the next year. And you're talking about a figure of around $8.5 trillion. In the 5 years that follow that first year, you got another $8.5 trillion roughly. So combined, you're talking about $17 trillion worth of debt that needs to be rolled over further out the curve over the next 5 years or so. That's a big ask. Now, it's not that the demand doesn't exist, but people know that this rollover has to take place. And so they're going to price themselves accordingly, which means that US interest rates are likely to remain elevated. Why that's important is because it has knock-on implications which undermine Trump's efforts to try and boost GDP growth. Hence his efforts to try and force the central bank, the Federal Reserve, to cut interest rates. But they're not having any of it at this stage of the game because inflation remains a little bit elevated. And so they want to see what the ultimate impact of these tariffs are going to be on things like inflation and GDP growth. What we have seen the central banks doing is gradually ending the withdrawal of liquidity. So you went through quantitative easing, which boosted their balance sheets very, very sharply. You saw that through the pandemic. The left-hand chart shows it very, very clearly. In the years that followed, they gradually tried to shrink that balance sheet to more normalized levels, and they've gotten about halfway back, except that the other half of all of this has already been deployed in markets, in economic processes, to households that have consumed. It's left the country. So any further removal of liquidity from this point is likely to impact quite negatively on GDP growth. So it follows that they would reduce the amount of liquidity draining that they're doing in the economy, and that's evident in the right-hand chart. And instead, what we think might happen later this year, if the US economy goes through a wobble and you see financial markets selling off quite aggressively, is that they might re-embark on quantitative easing. Again, a whole range of implications that we can discuss on that front. But what I've described to you so far gradually builds the case for the dollar slowly but surely losing some of that favor with foreign investors. The global dollar liquidity cycle is also collapsing very, very rapidly. And this is, I guess, another danger signal for not just the Trump administration, but globally as well. We have found that the 5-year cyclically adjusted money supply growth rate has now dropped to the lowest levels seen since the early 80s. It may even briefly flirt with going negative in the months ahead. Base factors are a key reason why that might be the case. The point to make, though, is that once you've got an economy that's used to utilizing cheap credits and cheap and plentiful money, and you drain that liquidity back out and your market interest rates remain elevated, it sets you up for a period in which you could have a lot of financial market volatility. And if you have a look at the labels at the bottom of this chart, all the busts in the financial markets, the equity markets globally, especially in the US, have happened in the troughs of this chart. And quite obviously, the fact that we've dropped off as sharply as this, I think, raises some red flags and tells us that we've got to watch out for the possibility that there's going to be a significant downturn. So the US is no longer looking as exceptional as it used to be. There was, in previous years, this US exceptionalism trade, which is very neatly reflected in the right-hand chart. From 23, 24, and into 25, you used to have the dollar moving very cyclically alongside bonds. the higher bond yields went, the stronger the dollar went, and vice versa. And why was that? Well, investors were trading on the carry trade. They thought, well, if interest rates are higher, then the dollar is attractive. They were also trading on the possibility of that US growth would be really, really strong. Well, you can see right at the end of that chart on the right that relationship suddenly broke apart. And that broke apart when Trump came into power and threatened the world with tariffs. Investors immediately started to price in the possibility that growth would be weak, and that the debt pile that would grow would undermine the attraction of some of those US bonds. So people are not going back into US bonds to the same degree, even though those interest rates are elevated. And now people are also focusing on the possibility that US growth is going to be weaker than expected. So what then for the dollar? Well, the chart on the left is quite useful because it gives us these big cyclical tidal waves that happen between commodities and the dollar. And what you tend to find is that commodities, or the way that it's interpreted, is that commodities hold intrinsic value for the simple reason that they can be utilized in production processes. They are utilized to create things. Therefore, there is obvious value in it. And to the extent that commodities are now really, really cheap and to our belief are starting to bottom out, and you compare that to the dollar, which on the flip side is amongst the most expensive levels seen since the early 1980s, one gets the sense that the dollar probably does need to correct. The Trump tariffs are in fact forcing that correction through the currency market. And so we're anticipating that some of the rebalancing that the Trump administration is looking for is going to be found through the dollar weakening through the course of time. That means that commodity prices in global markets are likely to rise, whilst that blue line, which is the dollar in the left-hand chart, is likely to come under a little bit of pressure. If we look for corroborating evidence, well, we can look at two metals which are very close to South Africa's heart, the one being the platinum price, which in the left-hand chart we have inverted just so that we can show you the fit between the platinum price and the dollar. The higher the platinum price goes, the more the dollar tends to retreat. And if you've been paying attention to the markets recently, that platinum price has surged very, very aggressively. If you have a look at the chart on the right-hand side, you can see that there's this widening disparity between the performance of the US money supply over gold ratio versus the dollar. That ratio has held rock solid for a very long time now. And to see it widening like this tells you that there are pressures building in that dollar that need to, at some point, adjust. And as it adjusts, we think that it will create an interesting dynamic in global markets where the dollar is no longer looked at as this safe haven place to just automatically park all your funds. Perhaps people are going to start looking elsewhere.
George, I'm sorry, just to interrupt you there. Now you're talking about the dollar. There's a question that Philip asked, but I know the slides is coming up about foreign holdings and you're going to chat about it, so I'll pop that question up when we get there. But the dollar's at its worst start to the year since 1973, and it's in decline still for the month of July. So it's been 7 months in a row that we've just seen the dollar decline. So I know and I believe the fact that we're going to see the dollar weaker in the longer run. But isn't there a short-term rebound probably possible in the dollar somewhere?
Yeah, I mean, if I just go back to this chart and focus specifically on the left-hand chart, that weakest start to the year is reflected by that small little pip down in that blue line. Just to paint a little bit of context as to how much further this could potentially go, and what previous cycles have looked like. So yes, of course, there's the possibility that it has sold off quite aggressively in the short term, and that some sort of a relief rally might follow. What might drive that relief rally? Well, let's see what Trump announces later today. It may relate to some of his tariff announcements that are going to come next week. It may relate to his big beautiful bill and how he plans to roll things out. But at this stage of the game, and if I pull back the lens and I'm looking at a multi-decadal picture over here, we're still anticipating a weaker dollar longer term. And how much weaker? Well, I would say in the coming years you could see the dollar losing at least another 10-15% comfortably. That doesn't mean that you're not going to have short relief rallies in the dollar. It just means that the longer term trend or the tide appears to have shifted a little bit when it comes to the dollar. And quite interestingly, if I have a look at the chart on the left here, where we are looking at the central banks and what they're doing, it's quite interesting for me to note how the dollar has lost ground even against the euro, despite the fact that the ECB, as you can see from this chart, has been cutting interest rates a lot more aggressively than the Fed. So one would have automatically assumed that because the Fed is more conservative, that the dollar should therefore perform better than the euro. In fact, the opposite has happened. And if you go and have a look at some of the nuts and bolts underlying that, you'll find that the euro is exposed to far better trade dynamics than the dollar is at this point in time. We've got trade surpluses in many European countries, and in fact, the eurozone as overall has got quite a balanced trade account compared to what you're seeing in the US. So these twin deficits in the US are certainly coming home to roost, and the fact that other central banks are cutting interest rates at the same time might, detract from the dollar being all that bad in the short term. To Wichard's point, could you see a little bit of a relief rally? Yes, of course you could. But I think in relative terms, the whole world is moderating interest rates right now, and we think that if anything, the risk to this picture on the left-hand side is that the Fed is forced to cut rates a little more aggressively down the line, if indeed that business cycle indicator that we've got tells us that there's going to be some difficulties in US financial markets. So to Wichard's point, and to just talk about the diversification away from the dollar, well, the chart on the left gives you a composition of world international reserves, and you can see the dollar steadily declining from levels north of 70, around 73, 74%. Back in the early 2000s, we're now sitting at about 58%. So, that has been the shift that we've seen over recent years. You'll notice that there hasn't been a tremendous shift into other markets, although there has been a little bit into the Chinese yuan and a little bit more into the yen, marginally into the pound over that time. But the big one is the other. That's made up a big chunk of it, and the other also comprises, we believe, gold. And so that's where other reserves are finding their place. So you are getting a steady rotation out of the likes of the dollar, and much of that is heading back in towards gold. And you've seen, for example, whether it be the Russians, the Indians, or the Chinese have steadily been selling out of their US assets, and they've been purchasing purchasing gold. The chart on the right is just a line chart, really, of the blue area on the left-hand chart. To give you that in slightly closer perspective, you've got the Chinese reserves that are reflected in the left-hand chart. That's the blue line. They've trimmed them from around $1.3 trillion down to about $750 billion. So that's been a fairly big moderation. In contrast, you can see what's happened to their gold reserves. Have steadily risen through the course of that time and are likely to continue doing so. The chart on the right is an interesting one because it correlates the trade-weighted dollar with the custody holdings. In other words, what foreign entities are holding of US treasuries. And you can see that there's quite a nice correlation between the two, with obviously a bit of a lag. I think it's a 3-year lag, 2 to 3 year lag. And what you tend to find is that the less holdings of US treasuries and US assets foreign entities have, and that's central banks in the main, the more likely the dollar is to lose ground through the course of time. And again, that is another major theme which we see continuing to unfold.
George, just back on your final slide, I've got 2 questions relating to foreign holdings in US treasuries. I'm going to pop now up the screen for you. So Phillips asked, what does foreign countries such as Japan dumping their treasuries have on the US borrowing costs and US growth? And the question relating to that is, what's the outlook for US treasuries 10-year given rising debt requirements versus a weaker dollar?
Yeah, two good questions. So yes, quite rightly, the Japanese have also been trimming some of their US treasuries. So it hasn't just been the likes of China and some of the BRICS countries. Japan has been trimming some of their holdings of US treasuries recently as well. It just ups the pressure. You know, you've got a world which is now preparing itself for a lot more bond issuance on the part of the federal government in the US. And so you've got all of this issuance. You've got the rollover risk that, as I alluded to in the one chart, 17 trillion over the next 5 years needs to be rolled over further out the curve. At the same time, you've got central banks that are rotating away from US assets and moving into gold. It's shaping up to keep US bond yields more elevated than they would otherwise be at this point in the business cycle. So at this point in the business cycle, you would have expected bond yields to be almost, I would say, comfortably 50, possibly even as much as 100 basis points lower than they are right now. After all, the Federal Reserve has started to cut interest rates. It's cut 3 times, and it has signaled that it will cut even more. So you would expect interest rates to drop. Trump has put pressure on the Federal Reserve to cut interest rates, but I don't think it's going to make much of a difference because the bond market is being affected by fiscal more than it is by monetary. What it might do is steepen out the curve a little bit if they cut interest rates, if the Fed cuts interest rates, and that can help at the very short end of the curve. But further out the curve, which is where a lot of the issuance and the rollover risk exists, those bond yields are likely to remain elevated. So what is the impact of that on overall GDP growth? Well, it detracts because so much leverage is off that US bond market. The longer US bond yields remain elevated, the higher the probability that it undermines GDP growth. And therein lies the difficulty. That's the conundrum that Trump faces. He is introducing this big, beautiful bill, which in part is aimed at boosting GDP growth. At the same time, if you look at the Congressional Budget Office and other forecasts of debt, of the debt pile of the US economy, it's pointing to that debt pile rising quite sharply, implying higher bond issuance going forward. So that's the tussle that's taking place at the moment. On the one side, it's more constructive. On the other side, it offsets and is more negative. At this point, I think it's very difficult to ascertain which pressure is going to be higher. But I think if you look at the way that the markets are trading, they're a little more concerned about the rising debt pile and the US losing some of that credibility as a safe haven than not. And that is what's undermining the dollar. So in answer to your question of the US treasuries and the relationship with the dollar, well, you've seen more recently that relationship breaking down quite sharply. So I don't know that US treasuries are any longer the barometer to use for where the dollar should be trading. They're almost treating them as two separate markets. And in fact, the rise in US treasuries right now is not seen as an opportunity necessarily to go and expose your portfolio to that, or at least that's the case right now. It's been looked at as a barometer for risk in the US. And so those US treasury yields are remaining elevated because of risk. And that risk has people turning a little bit gun shy in terms of where they are placing their funds. Now, the central banks know all of this. And so those that are holding US treasuries are going to be bleeding US treasuries into the market. They're not going to do it too aggressively out of fear that they're going to spike those US bond yields and induce a big economic correction in the US, which is in nobody's interests. So they are going to bleed those US treasuries into the market very slowly and gradually over time. I suspect Japan's going to be doing it just as much as the Chinese are going to be doing it, and other central banks as well. The good news for South Africa is that it's boosted some of the commodities that we happen to mine. And so if we could just get our mining production in order, that would make a huge positive impact on South Africa's economy. Also, on the point of Japan, and I think it's just worth mentioning, Japan has been looking at normalizing their monetary policy, and in so doing, what they've landed up generating is a phase of yen weakness, not over the past 6 to 9 months, but prior to that. And that weakness prior to that induced a lot of inflation that has come through the system. And you can see that quite clearly in the orange line, final prices rising. It has forced the central bank to hike interest rates. And if I go back to the table, this particular table, you can see that Japan is one of the very, very few countries that has been jacking up interest rates, raising interest rates in order to offset this rise in final prices. The result is that it's resulted in asset price inflation, which is the blue line, coming down. So in other words, asset prices are now under pressure. And so Japan in itself is looking a little bit precarious. But what it does tell you is that the carry trade that was being funded out of the yen into the US is not going to happen at the same pace as it used to. Partly, they're going to be repatriating their funds to help finance some of the losses that might be sustained back in Japan. Two, we think that there's some of this is being utilized as leverage in the trade negotiations between Japan and the US, which is why the US or Trump has actually come out and said the negotiations with Japan are proving difficult. And then finally, Japan is obviously wanting to try and normalize, because at the pace that they were going on, their debt to GDP ratio rising to north of 260% of GDP is clearly unsustainable, and they need to do something about it lest they suffer a big correction of their own. So if we had to pick one big theme, which we think is going to be the big differentiator going forward over the next couple of years, it's going to be fiscal. How countries manage their fiscal position is going to determine just how positively they are perceived through the rest of the world. At the moment, fiscal is bad, almost doesn't matter where you look. The chart on the right gives you a sense of the budget deficit pressures that you're seeing everywhere. The low-income countries seem to be about the best at this stage, ironically. But it's your emerging economies and your advanced economies that are your biggest culprits of some of this fiscal deterioration. And whether you look at actual government debt levels, that's indexated on the left-hand chart to show you which ones are the worst culprits, the UK being particularly bad, Japan not far behind, and followed by the US. Those are some of your three biggest economies, and they're all struggling with enormous quantities of debt that need to be brought back under control. At this point, it's very unclear whether Trump's big beautiful bill is going to accomplish that at all.
George, just before you go on to the local side, I've got one last question relating to the reserves that you talked about. Someone has asked, could crypto also be listed in other in relation to the reserves?
It might, but I think it's very, very small, and the indications that I've gotten from central banks is that they're not playing in that market just yet. No, I wouldn't put that as a significant contributor to that. It's certainly going to be more towards gold than it would be towards crypto. Crypto is obviously a good differentiator, and some of the central banks are looking at crypto, but it's far from having been adopted wholesale just yet. There are other potential problems and pitfalls with crypto as to the control of it and the illicit flows that can sometimes be promoted by it. So there's all of those types of considerations which negatively detract from crypto as a reserve asset at this point. It's also you're purchasing an ability to pay in a currency. You're not purchasing an asset. So in terms of reserves specifically, reserves tend to be assets that you can show, you can pick up, you can kind of trade with others. At the moment, that might change in the future, but that's kind of what it is for now. In terms of the shifting to local, quickly, just to give you an update on how we're seeing economic activity. Our short-term cyclical indicators have popped a little bit higher. They're in buoyant territory, but not, but hardly in favorable or highly favorable territory. We just sort of popping back up, and much of that has been driven out of the recovery in the vehicle market, interestingly. So we've had some improvement on that front, and that has helped that green line pop a little bit higher. I think the bigger concern for me is the black line, which reflects more your longer term structural cycle, and that still remains in very challenging territory. Admittedly, it's moved from adverse territory into challenging territory, which at least is something positive. But really, South Africa needs to focus a lot more on implementing some of its structural reforms and implementing Operation Vulindlela if that black line is ever to rise significantly further. As I look at our presidential policy scorecard, we're still below the break-even 50, but we're moving towards it, which means we are deteriorating at a less rapid rate. So let's be thankful for small mercies. We're out of the depths of despair that we saw during COVID and shortly after, but we still got some work to do. And this GNU is obviously, there's pros and cons to what's going on there. On the one hand, none of us like to see the infighting that continuously seems to take place. But on the other, you also need to appreciate that infighting is a form of accountability being imposed on the parties within the GNU, most notably the ANC. So the ANC didn't get its own way with regards to the budget. In times gone by and years gone by, they would have just forced it through. They weren't able to do that this year. Equally with other policies, they are now being highlighted, and it's much to the frustration of the ANC. A lot of its own policies are now being openly questioned, which is something we've never had before. So there's open questions about policies like BEE and expropriation without compensation and a few others. The whole ideology of the ANC is being questioned within the GNU, and it's becoming more and more public. It's not that difficult to do anymore in the way that it was historically without being called a whole bunch of things. I remember once being called a neoliberal, I can't even remember what it was, anti-transformationalist. And I smiled at the time because I actually didn't know what that meant, and I still to some degree don't. But that was the kind of pushback that we got whenever we wanted to try and criticize the policies of the day, because we felt that they weren't helping the country. And well, over time we've been proven right, but we're still battling an ideology within the ANC that isn't going away anytime soon. So we're still sitting, and this is the epicenter of the problem for South Africa, and specifically the chart on the right. The debt to GDP ratio is still rising. Our debt servicing costs as a percent of revenue is 20% of our revenues are being utilized just to service debt, and that's because of wasteful expenditure and spending in the wrong places. A government that's bloated, overheads that are just simply too high. I mean, if there were ever a country that required a Doge type approach to government expenditure, it would be South Africa. And the result is, as we've spent in the wrong places, we haven't spent in the right places. And so if you had to ask me for the one indicator that we need to focus on that gives us a sense of whether South Africa is moving in the right direction, it would be gross fixed capital formation as a percent of GDP. Under Thabo Mbeki and Trevor Manuel, they were targeting a minimum figure of 25%, but the National Development Plan had a figure closer to 30%. Well, we're less than half that now. And so that was the destruction of the Zuma era, is that he was the one that instigated the big shift from spending in the right places to spending in the wrong places, and to spending on social consumption rather than spending on investment into infrastructure, which is the backbone of any economy. Without that backbone, you simply cannot conduct economic activity efficiently, and so that's where it all falls apart. Well, we still haven't turned the corner on that. Despite the fact that Ramaphosa talks about R1 trillion to be spent over the next few years, we're not seeing any evidence of it yet. And more to it than that, if you look at the breakdown of this particular chart, you'll find it's still the private sector doing all the heavy lifting. So if you wanted to know why I'm so vociferous in my calls for just the government getting out of the way and allowing the private sector to play a bigger role is because the private sector has been the one that's driven any investment in this country to a significant degree. So what does that mean? Well, it means that our carry attractiveness is high because, well, we've still had to run with high positive real interest rates. Part of that is because we run our country poorly, our fiscal is bad, so our interest rates have to be higher. But now we've also got the Trump tariff imposition, and the fact that we don't know what that's going to imply for South Africa and whether that detracts more from GDP growth, which means that our fiscal metrics might worsen. It means that because our interest rates are so buoyant, that our carry attractiveness, ironically, is quite good. So we've shot to the top of the rankings of the carry attractiveness rankings. In terms of our performance, well, we kind of mid-tabling, but in the top half of the table. If the chart on the left is anything to go by, if I updated it for today, that black line would have ticked a little bit higher. But the story of the moment really is the chart on the right, which is our commodity terms of trade, and with platinum rising as it's rising, with gold doing what it's doing, and with other commodities also being supported, we've got the best terms of trade that we've seen since the pandemic, and that really is good news for the rand. It tells us that rand could still appreciate further through the course of the next few weeks and months. That's not detracting from what Wichard was pointing to earlier, that you get these periods where rand is quite stretched and needs to go for a bit of a correction, but if it does go through that correction, I think your bias that you will hold is more towards rand appreciation. Looking at these two charts to give us a sense of where we are in terms of fair value. Well, in terms of fair value, we've actually ticked below fair value. This is on a purchasing power parity adjusted basis. We're slightly below fair value. If you look at the forward points that you would add onto the rand where it's currently trading, hovering below fair value, and you compare that to where your options market is trading at the moment, you'd probably say this isn't a bad time for importers to enjoy slightly better trading conditions. So and if the rand goes further from here, well, utilize that opportunity to lock in slightly better and more attractive levels. That's what the statistical model is telling us. If I have a look at our rand sentiment indicator, it's popped back up into positive territory. So it's also telling us that the options market is saying that rand can still appreciate further from current levels. All of which means that we think that with the rand much stronger, that inflation continues to hug the lower limit of the 3 to 6% target band, and that interest rates can come down, despite the fact that the Reserve Bank is actively pushing towards lowering that inflation target to 3%. I was fortunate to attend the Reserve Bank's biennial conference in Cape Town earlier this year, where they imported a whole bunch of experts on inflation targeting from around the world, and we got presented to and had panel discussions by these experts, and without fail, every single one of them just built the case for why the South African authorities should be lowering the inflation target to 3%. It would bring us in line with emerging market norms. The emerging market average is about 3%, so it would bring us in line with other emerging markets and would bridge the divide with developed markets. So it means that the rand, from a purchasing power parity perspective, would not have the need to weaken as dramatically as it has done in recent years. And the hope is that by adopting a tighter monetary environment that helps maintain inflation at much lower levels, that price stability translates into some stability in the rand as well. And so over time, that would generally be more positive and constructive for South Africa than not. And so, Wichard, that brings me to the end of this presentation. Very happy to take any further questions if there are any.
Yeah, so George, just want to ask range for the rand that we're looking at trading for the next 6 to 12 months? Is it sort of 17 to 18 type of range, or what is your expectations on the local currency? And obviously longer term, you talk about the weaker dollar, but how does it impact our cross currencies as well?
Yeah, so against the euro and the pound, I think rand has a tougher time. Against the dollar, I think rand may even break below 17. I think that's quite possible. So if you had to ask me for range at the wide, I would say more like a 1670 to 18. I think is possible, maybe even slightly below 18. But that for the next 6 months. 12 months is difficult because in that time I am expecting the global economy to roll over and to go through a difficult patch, which I think might get reflected in financial market volatility, which is going to induce some volatility across the emerging market spectrum. So against the dollar, I see us doing a little bit better on a trade-weighted basis. Therefore, I do see rand appreciating, but against the pound and the euro, not appreciating to the same degree as against the euro, but still appreciating by virtue of the fact that we are doing quite well on a terms of trade basis, that our trade account is deep in surplus, that our interest rates are attractive, so that boosts the carry attractiveness of South Africa. And I'm hoping that eventually we start to see some of these reforms that have been threatened in Operation Vulindlela to get implemented. And I think if we get that combination, I think there's enough support there for the rand to help it find a base at a firmer level than what we've been used to in recent years. I think that's quite possible. Bearing in mind also that come October this year, South Africa is likely to be removed from the grey listing. So if the Financial Action Task Force removes us from that grey listing, I think one of the IMF reports that they produced on countries that entered grey listing is that in the 3 odd years that follow, they could lose up to 6% of GDP in terms of capital flows. Well, if being removed from that Financial Action Task Force grey listing helps reverse some of that, just bear in mind that there could be a little bit more that comes towards South Africa in terms of portfolio flows. So the picture that I'm painting is a more positive one for the rand over the next 6 months. But the biggest caveat to that is whether global stock markets go through a significant wobble later this year. If the pressures of the tariffs, for example, and higher US bond yields, etc., start to detract from GDP growth such that eventually that finds expression in weaker earnings, and those earnings cause a correction in stock markets.
George, there's no other questions at this stage, and I think you've given us a broad update about what's happening in the markets. Everybody's got a good grasp of what's going on. Definitely the weaker dollars front and center, and we need to watch it. And all the data out of the US obviously remains key, so we'll continue to watching that. The US is out of the market today, so they're celebrating their independence. So from that front, I'm going to say thanks to everybody for attending, and George, thanks again for your time, and we look forward to speaking to everybody again. If you've got any questions, feel free to reach out to us, and we'll see if we can answer any of them. Thanks everybody. Enjoy your weekend.
Thanks everybody. Have yourselves a great weekend.